The taxes on this house in Island View, valued at $355,000 from the last sale in 2024, are about $4,800 a year. The taxes on this condo in Harbortown, valued at $355,000 at the last sale in 2024, are $10,200, almost double. What is going on here, and is this fair? In this video, I am going to go over the mechanics of tax assessments and why it is the case that condo valuations sometimes are higher than home valuation. My name is Jan Dijkers, and I am a 20-year real estate veteran in Detroit and Metro Detroit. I have sold thousands of houses in my career, and I love working with emerging markets, with condominiums, historic properties, and I love hearing from people like you who are interested in talking about property taxes. I'm currently a broker with Berkshire Hathaway Home Services, the Loft Warehouse in Detroit, and I'm one of the top agents in my market. You may have noticed that property taxes for condominiums in Detroit can be very high. Is this fair? Well, I suppose it depends on who you ask. It all has to do with how an assessor values a property from a tax standpoint. Assessors do not use the sale of one house to determine its value. In fact, they are not allowed to do that under state of Michigan law. They have to use an average or a range of similar houses in a specific area called an economic zone over a specific period of time. In Detroit, it's a 2-year period. The simplest way to explain it is that an assessor takes all the sales over that specific period of time in that specific zone, and they create an average to determine the assessed value of a home from which the taxes are calculated. I review all of this in more detail in my video, How Property Taxes Are Calculated. Because this is an average of all the sales in an area, the assessed value could be less than what a property is worth on the market, but it definitely should not be more, especially if you purchased it for market value. As you may have noticed in the city of Detroit, the areas can vary greatly from block to block. In an emerging area like Island View, you might see some very high sales of some houses that have been renovated to the nines and are able to fetch top dollar. And then you are also going to see some very low sales from houses that need full renovation, that are blighted and in very poor condition. This skews the value for the average of all those houses combined to much lower than a house might actually be worth on the market. And this is why a home's tax assessment can be much lower than the market value. In my original example at the top of the video for that house in Island View that sold for $355,000 at the end of 2024, the tax assessment for that property was only $111,000. That's about 31% of what it sold for. Now, the condo market is much different. For the most part, condominiums do not have that same value variation in a neighborhood that is emerging where you see a lot of high value homes and a lot of low value homes. Condominiums have not suffered the same abandonment and blight issues that have plagued the city of Detroit over the last several decades. The example that I gave at the top of the video regarding the condominium in Harbortown that sold for $355,000 at the end of 2024, its taxable value was $238,000, or about 67% of the market value. So that's a much bigger difference than the Island View example. And I have even seen condos get assessed at 100% of their market value from a tax standpoint. And I should mention that when you have properties in an area that is much more stable and the home values are much more in line with each other, like a neighborhood like University District or something like that, the properties are going to be taxed closer to 100% of their market value than an area like Island View that's in transition. So now you know why these condominium taxes are high, or at least a lot closer to their market value than some of the houses that you see on the market. Do you think it's fair? Let me know in the comments. I'd love to hear from you. Thanks for watching.